Good evening, all. Ira Epstein with your financial market wrap-up, and this wrap-up is for the evening of Tuesday, the 4th of August, 2024, time 6:25 p.m. We had a huge break on Monday in stock indices. Yale Hirsch of the Trader's Almanac used to talk about Tuesday reversals and other parts of the market that he learned these phenomena on. I was fortunate when I had a TV show on what's now CNBC. I've interviewed him and many others, and you learn all these techniques. So often, and the word is, you'll hear the word Tuesday reversal. Does it apply to all markets? Not really. The one that I found that applies the best to is the stock market. I mean, big moves on a Monday, you can get a correction the next day, doesn't last. The idea of the Tuesday reversal, and we had it happen in a number of markets today, I must say that, is the market will try to reverse some of the big move of a Monday. In the case that we broke down, it's trying to rally, and most markets spent a good part of the day doing that, all right? In the last 30 minutes or so of the stock market, though, the big gains, maybe the last hour, it started to shave all that off, and it was an interesting morning, to say the least. And now the question is, where are we? That's going to be important. We don't have any major news coming out. We have the Mortgage Bankers Association number at 6 a.m. We've got the Federal Reserve Consumer Credit. That comes out at 2 in the afternoon. The EIA petroleum stockpiles at 9:30. And we just got this afternoon at 3:30 the API numbers. And there's a slight build in all of them. And that's what's weighing to a certain degree on prices tonight on the energy complex. So keep your eye on that. Bonds and notes fairly stable, but let's go to the charts and talk about what we've got. As you can see, the market, and this is always fun to come back to, this is where the market finished on Friday. And this is a close-only weekly chart. That doesn't mean it doesn't take each day of the week and plot it, and it does. And right now you are underneath, for the first time in a long while, since back here in November, the 18-day moving average of closes. We're in a transition period. It's that simple. Everything from May and June and a good part of July, no matter what you threw at the market, it was bullish. And we kept seeing in this market and other stock indices, analysts keep raising forecast upon forecast and being giddy about it. I think you realize that, until the market finally caught those traders and the market has come down. So the market is concerned, very concerned. Why is the Fed going to have to or going to cut interest rates? Two different phrases there by design. The reason that they'll be cutting interest rates is because the restrictive policy may be now proving too restrictive. Do they have to cut? No. Is certain analysts calling for it? Absolutely. You've got Jeremy Siegel of Wharton, if he was on Monday, and he's saying the Fed should go 75 points now, 75 points again in November, and maybe 50 points in December. I get it. There's others that are thinking the same thing. And most of the major banks, JP Morgan, Goldman, and others, think the Fed will be cutting rates. But Goldman agrees with me. There's no reason for an emergency cut right now. Give me what the emergency is. That the stock market is down? That isn't enough. So you have to dig deeper, and that deeper is going to be that the economy is slowing down. That could be one. That labor is getting hurt. That'll be number two. Those are the things that they have to look at. And they are certainly part of the stability and full employment mandates of the Fed. But are we at a crisis level is the question. I think that depends on who you ask. If you ask certain people, the Fed's way behind the curve. They're going to get us into a recession, and you got to be careful. Others think the Fed can move in an orderly manner. If they want to go big, go to a 50 basis point cut, possibly, the word is possibly, in September. But it's too soon on August 6th to make that decision. So the only decision to be made, and that was the calls by some, an emergency intervention, if you will, and the Fed steps in for a cut. I'm not seeing that happen, but that doesn't mean I'm right. You had a huge decline, as you know, in this market on Monday, all right? And the market has since come back down, came down here, bounced today, and now the market is playing games with that bounce. So this was the reaction that I said. Monday, big down, or it could have been a big up, and a Tuesday reversal of part of that. In doing so, you have a higher high and a lower low. Now, let me give you the parts to get nervous about. Was this what we call in the trade a dead cat bounce? In other words, the market's down hard, it rallies, and as you could see, let's see if I can get this to come back. I can. If you look at the range, 53.41 to 52.21, well, you closed near the bottom of the range. You gave up 80 some odd points of the rally, okay? So it was down pretty good, and it didn't act that great. Now in the early evening trade, let me get over here, you're down a little bit. If you take out the lows of today, Tuesday, that would then give you lower highs and a lower low, bearish signal. If the market can just stay like this, you don't have anything in the near term. So something we've got to be watching. The market wasn't strong enough to get back to the 100-day average. That's a sign of weakness, not strength. The market bounced away from the 200-day average on its very first challenge of it, and it hadn't been there. You can see back to when this contract came on the board. Some futures contracts, you can get 200-day averages going way back. Others, because of the life cycle of them, they're a shorter life cycle to how the exchanges bring them on. You need a lot more time. Remember, 200 days is almost a year. Do you honestly think right now, if you go a year out in September for the futures contract, do you have much volume or much interest? No. So got to be careful. Where did the market stop? Well, all it did is move to the right-hand side of the Bollinger Band. And 95% of the time, that is what a market will do. But if it starts leaning on this band and staying with it, the next stopping spot could be the 51.30 level. The good news is, if there's good news, is that the market's very oversold and it can react any which way right here. The other piece of news is there's not a lot of market-making news happening. We saw that Vice President Harris has chosen Tim Walz to be the VP there speaking tonight. So far, nothing happening with Israel other than has been launched a lot of different missile objects, but none at major cities, as I understand it. And now people are saying that isn't the attack, and we all know that. Something bigger is happening. There's been coalitions, attempts to talk in Iran, don't create another major front. I am sure Iran has got the message. That doesn't mean they'll listen to it, but they've got the message, and they've also heard that the allies will support Israel, and they will be there, but none of them want to have to attack Iran or have a stomach for it. When we take a look here at the Dow, higher high, lower low, same thing. You went to the 200-day average. You then bounced today. I can just show you this real easy. There's your bounce. And the market settled right by, the word is by, the lower Bollinger Band. Okay, still a little bit under it, but right by it. When we go to the Russell, higher high, lower low, look where this market found its support, right at the 200-day average. And the resistance today, this is even better, because what the market did is on its resistance, it went to the 100-day average and it stopped right there. So what had been a point where the market, when it finally cleared this number and it took off to the upside, it's back to being a resistance point, at least it was today. When you look at the notes, higher highs, higher lows, but whenever I see a lost embedded reading, and that's what happened there, be careful. This market can leak back on you towards that 18-day average. What about here? The same thing, identical. This market could be leaking. If we take a look together, I'll just go with this because the 5-year is so popular. All right. So you have both numbers under 80, and here's the first day they're over them. The next day, they're both over 80. This was Friday's close. Yesterday, both over 80, and today, the market loses both over 80. When that occurs, as it has here, before you go up for this high, it is not uncommon for a market to make a hard run at wherever that 18-day average is. Keep that in the back of your mind. In the dollar index, you fell like a thud here, and you've latched on to the Bollinger Band, and that's pretty much what's going on. The market is now in a bearish phase. You could easily get the 18-day average in the next few days under the 100, and that becomes another bearish factor in the market, and certainly a big resistance point. In the eurocurrency, you went from the lower Bollinger Band to, on Monday, the upper band, and you set back. Again, one of these big moves up, and then you give a little bit back of it. Not a trend change, but no trend here. The market's got to establish one, and what it's established is a monster trading range so far. 108, 07 and a half, all the way up to yesterday, 110, 30 and a half, all happening, kaboom. I mean, that's a big move, 213 points or so, 214